Good afternoon, everyone. Welcome to today's session. We're going to be talking about the good old-fashioned collar. Now, this is a strategy that we use to hedge a position. We can do it, we can have it going on a regular basis and have a collar that is rolled on an ongoing rolling kind of collar, or we can use it, employ it basically to get us through some difficult periods, through a Fed event, through an earnings event, etc. And the nice thing about it is that it's relatively volatility agnostic. So one of the problems with buying protection in the equity markets is it can get quite expensive, right? Your house insurance is a relatively small portion relative to the full value of your house, generally speaking, on an annual basis. It's something that we don't love to spend the money on it, but it is doable. It is a cost that is quite acceptable to us for the peace of mind that comes with having insurance on one of our greatest assets. In the stock market, things can get a little bit on the expensive side. So the collar is a way to address that problem. And I'm going to show you how that works. The collar is made up of a couple of pieces. It's made up of what is essentially a covered call, and you're going to use the premium that you receive from that covered call to buy downside puts. Downside put structure. You can structure collars in different ways. We're going to keep it simple today. It's going to be selling a call to buy a downside put. We're going to try to finance the put with the premium that we're receiving from that call. And so we'll talk a little bit more about how that math works. But we'll talk about what that collar is and how do we build it. We're going to go in there and I'll show you an example. Why do we use those collars? Well, we've talked a little bit about that already for protective purposes. And we're going to talk about adjusting those levers to get the desired outcome that we want, because there's some ideas out there that you have to do things a certain way and you have to try to do them for costless, basically not spending any money on the collar. That's not necessarily true. You're going to be able to adjust things, and we're going to go through why that's important and why you get this sort of asymmetrical payout from the upside to the downside. There's a very good reason for that, and we're going to go over that in a moment. So this is one of the things that we teach in the program. I ran Black Swan funds, $1 billion worth of option overlay funds, and always considered using protection, VIX butterflies, downside protect, put spreads, put structures in order to protect those assets. So I've been doing this for almost 3 decades now, and downside protection is just a part of what I do. It's second nature to me because I've been through enough bear and bull markets to understand that things don't just go up. And so, I see some folks out there who've never really been through a bear market, some of the option experts you see on Twitter, etc., who are now suddenly rushing out to watch every YouTube video they can to learn more about downside protection. And, I think it's something that is a little bit more complex than simply going out and reading a short handbook on the subject matter. So you can see here that one of my students very recently talked about how and this is something that I teach in most of my programs, I taught him the collar, and he said that he made 200% in a single day on his AVGO collar, and before that he made $15,000 on his SMCI collar. So again, right there, probably paid for 25 times the cost of the Cash Flow Insiders program that teaches you every aspect of what you need to be a great option seller, but doing it smartly, considering risk management. So a nice success story there, just one of many. And so let's talk about how this works. We're going to start building one right now. So let's move over to Thinkorswim. Okay, so here is our P&L for our covered call position, which is the first part of this strategy. So we're long 100 shares of Tesla at 227.80. And what we're going to do is we're going to look for a call that achieves the covered call that we want. So we're going to look through here. The stock's trading at 227. I'm going to look down and I'm going to choose the 255 call. So I'm going to sell one of these for $12.35. Now remember, again, one call obligates you to sell 100 shares. So you want to at least own 100 shares of Tesla in order to be able to sell one call against it in the covered call strategy. I'll be doing other videos on covered calls. They're near and dear to my heart. I ran hundreds of millions of dollars in these products, ETFs, strategies like this for many, many years. So very, very fond of the strategy. And it just so happens to be the first part of the collar here. So we're going to sell one of these calls against our 100 shares of Tesla, and we're going to take a look at the performance profile. So we can see the teal line here is our performance at expiry, and the sort of magenta line is our real-time performance. So this is how our P&L is going to move in real time, and on expiry, which is always a good line to look at too, we know exactly how this position is going to look. If we don't touch anything on expiry, of course, we know that the calls are either going to be worth something or they're going to be worth nothing. And so above 255, our calls are going to be worth something. They're going to have some intrinsic value above zero. Below 255, the calls won't be worth anything. But we will have received that $12.35 for them. So as you can see here, we're able to make money from 227 all the way to 255 unencumbered by the covered call. So that doesn't get capped at all. And then at 255, we have our performance capped, because beyond that price, the counterparty, person who bought that call, is going to be able to exercise it, and we are obligated to sell them the shares. It's anonymous, but we're going to just say them. So they are going to be able to take those shares away from us, and that's why they bought them, right? They want to have the right to buy the stock at 255, and they have, in this particular case, 58 days for that to happen, for that positive event to happen for them, which is possible. 58 days, almost 2 months. We know Tesla is a volatile stock. They are paying a good amount of money for those. They could be right. They may not be right. We don't know what the future holds. But what we do know as a covered call seller is that we can monetize that expectation that Tesla is going to potentially go up past 255, at least by the amount of $12.35, because they need that full amount before they even start to make money. That break even is a little bit higher than 255. We are able to monetize that expectation. That's one of the beautiful things about covered calls, is we can turn expectation, sentiment, a view on the market into cash flow. And so I can turn this into $1,200 and the $1,235 of cash flow for this particular Tesla holding that I have. And rinse and repeat. I can do that throughout the year and potentially generate quite a bit of option income in that fashion. Now, what if I'm worried about Tesla going through a particular event? So we're going to look at the chart here. We can see that Tesla's been coiling and coiling and coiling, which is quite interesting in itself. We can see that Tesla certainly seems to want to make a move at this point, either above this pattern or below the pattern. We're not sure. We know that that markets are at all-time highs right now, and that could be bullish, could be bearish, could be a sign of an overextended market, but we're not sure. And we're going through a seasonally difficult period, late September, early October. We know that can be a difficult period for the stock market as a whole, sometimes for technology in particular. And so we're looking for a way to basically hedge this position. So part one is selling that covered call, which is going to cap our upside. But this time, instead of just keeping that $12.35 that we've received for the call premium, we're going to use it to buy a downside put. So let's see what that looks like. We've taken in $12.35, and what we can do is we can go out and pay $13.10 for the 210 put, for the November 210 put. So we're going to plug that into our position monitor. We can see that we are long 100 shares, we are short a 255 call, and we have used all of that premium and a little bit of extra money to buy the 210 put for $13.10. So what does that mean? Well, we've spent a little bit extra, haven't we? We spent 75 cents. We've spent the difference between $13.10 that we're spending and the $12.35 that we're receiving. Let's see how this looks. Well, it looks like this. So what do we have here? Well, we have what we accepted before, which is a limited upside. Now our limited upside is not going to be giving us that extra bit of of break even. If we just did the covered call, then our break even would be 255 plus the 1235 that we received for the call. Right now, because we spent that money on a put, our break even is 255. So anywhere above 255, we can consider that to be an area where we are foregoing any further upside in Tesla. Now, in this case, we've actually bought a downside put at the 210 strike. So even though Tesla's trading at 227, what this is going to mean is that we cannot lose money below 210 less the extra 75 cents that we've spent. So our break even is going to be 209.25. 209.25. And below that price, we are going to be 100% protected on our Tesla holding, which is a really nice thing to know. Tesla is a very volatile stock. It's a stock that can potentially go anywhere. Now, there is a slight deductible, right? Because from 227, strictly speaking, to 210, we are going to take the full brunt of that particular $17 loss. So we can think of that as a kind of deductible. On your house insurance, you might have a deductible. On your car insurance, you might have one. So there's a little bit of a sort of commitment to the insurance company, in a sense, before that protective insurance kicks in for you. But in this case, it's nice to know that really not far below 227, certainly a lot less than 10%, we are able to protect our Tesla position all the way to zero. So what have we done here? Well, we've done our covered call. We've done our protective put. And again, I mentioned earlier, the nice thing about this is that we're relatively volatility or price level agnostic. So under normal circumstances, if I take away the put, or rather if I take away the call, I could just protect my downside in Tesla by simply going out and buying that put for 13.10. So in this case, I haven't sold the upside call. I've just said, you know what? I want to own Tesla, but I want to have a little bit of insurance to the downside. So I've gone out and I've bought this put at the 210 strike and I've paid 13.10. Now 13.10 is not inexpensive for Tesla, perhaps. It's not that bad, but it's not inexpensive. And we're going to compare the cost of that to the price of the stock, which is about 5.7%. So you're spending 5.7% for 58 days of protection only to protect your Tesla position below 210. That's a lot of money. If you annualize that, you're probably looking at, 30 plus percent, close to 35%, to protect that Tesla position on its own. And that's not an insignificant amount, right? That's a very steep amount. Now, in Tesla in particular, because the implied volatility is quite high, that cost is going to be higher. It's going to be much higher than it would be on a J&J or a Pfizer or something that doesn't move very much. It's going to be higher, and we call that implied volatility. It's that protection comes at a higher cost. And so if we look at the implied volatility chart on Tesla, we can see that right now it's actually trading quite high. We're looking at around 66, 67%. If we look at this little teal number, this little blue number, 66, 67% implied volatility is quite high, considering it can trade as low as 48%. So the problem is, and this is 30-day volatility, but we can assume that November is going to be a little bit more expensive as well. But we can consider that to be quite high because as we pay something that is probably a little bit closer to the 52-week high on Tesla, we're paying a cost of insurance that is quite a bit higher than, say, the average. By selling certainly much higher than the low. And so that's why we add the call to the strategy. We should be concerned about that. But the nice thing is that we can go out and there's no free lunch. The cost of that doesn't come at a zero cost. We understand that if we only own the put, then we have unlimited upside in Tesla. Tesla can go to $400, $500, $600, and we are not going to be capped on that performance. A big factor in doing the collar is that you are giving up some of that performance. Now, you may feel that 255 is a pretty healthy run, a $30 run in Tesla over the next 2 months, and that may embolden you to put on this collar because you feel that, well, if I were to get called away, I'd be pretty happy with that 255 price on Tesla. And I've done well. Maybe I've owned it from the 100 somewhere, and this is going to be a price that I'm quite pleased with. But you do have to accept that you are going to give that stock up at 255 unless you roll the structure. And what we mean by rolling is at some point before expiry, you're going to roll that strike price up. You're going to go from a 255 strike perhaps to a 275 strike, and in all likelihood, you're going to roll up and out. So you're going to roll up to a higher strike price, and you're going to roll out, which means to a further distant expiry. Maybe next month, maybe the one after, you can decide what expiry to use. So there's a lot of flexibility in there, and pricing may help you to decide on where you roll to. But if you're not interested in rolling and you're willing to accept the fact that you may give away that stock at 255, then great. This is sort of an easy one to manage. You just kind of set it and forget it. Now, until something happens and Tesla goes down, and then eventually you're just going to have to deal with the fact that, well, you're going to get your stock either called away, or you're to the downside, you're going to sell your stock because you're going to exercise that put that you're long, and you're going to sell Tesla at the price of 210 because the person who sold you that put is obligated to buy the stock from you at 210. So the obligation to the upside has you giving away the stock potentially. The right to sell stock has you selling your stock at a higher price. Doesn't matter if Tesla goes to 130, 140, 150, you're going to have the right to sell it at 210. So that's a nice thing to know. So there's your collar strategy. Now, I've decided to put this on for a 75-cent debit, meaning I'm paying out a little bit more for the put than I'm receiving for the call. And that's fine. Some people really believe that you should only put on collars for a neutral cost. Basically, you're not paying anything, you're not receiving anything. Sometimes if you know, you can even put them on for a credit. If I sell a call, if I move this call to the 245, look what happens. I'm going to receive $15.50. So suddenly, I've moved my call strike down to the 245, so I'm getting $10 less in my obligation to sell that stock to 245 instead of 255, but I'm also receiving an extra $3 or so. So I'm receiving those extra $3, but that ends up giving me, on the entire structure, giving me a credit, right? So I'm selling something for more than the put I'm buying. So I'm going to put this collar on for a credit of about $2.40. And so that's nice. You know that if Tesla just kind of sits around in here, worst case scenario, if it doesn't breach to the upside or the downside, you're going to collect an extra $2.40 for having put this collar on. And that's great. That's sort of a nice way to look at it as well. So you can almost look at it as something that gives you a little bit of the covered call portion of it, which is something we typically do to generate some premium, some income, but gives you that protective side of things as well. So you can kind of go halfway, but of course the part that you're giving up is that you're obligated to sell that stock a little bit lower should Tesla want to go for a big run to the upside. Now, a lot of the time you're going to actually get a lopsided distance from the stock price to the call strike versus the stock price to the put strike. And that's because of something called skew. And I've covered skew in another lesson. I'm going to put the link in the description below. But effectively, what we're talking about is something called skew, which prices puts generally more expensively to the downside than the upside calls are priced at. And so that's something you may have heard of it. It's called the volatility smile or the volatility smirk. in the case of index a lot of the time means those downside puts, because markets tend to go down faster, they tend to crash down, not up. So those out of the money puts generally cost more in terms of implied volatility than the out of the money calls, which are being crushed by covered call sellers, just like I used to do in the old days. People like me selling thousands and thousands and thousands of calls and compressing that volatility to the upside lower. So there are many things that go into why the skew exists, but effectively a lot of it is supply and demand. And there's more demand for puts, and people are going to pay a more expensive price for them. They're mandated to buy protection. That's simply the way things are, since we're well aware of the fact that crashes tend to happen to the downside. So that skew is going to affect the pricing. And so I've come up with an example for you here. So with the SPY trading at 562, I'm going to move equidistant down about $30, which gives me the 530 put, which I'm paying 528 for. And I'm going to move up about $30 to the upside, and I'm going to sell that call for 350. So isn't that an interesting thing? This is exactly what I'm talking about. You're receiving quite a bit less for the call than you are paying for the put. And that's because of the skew that I mentioned. Those downside puts for a similarly distant strike are going to be more expensive. You're paying 528 for this put, that is $30 out of the money, and you're only receiving 350 for a call that's about $30 out of the money. So that doesn't seem very fair, does it? Well, that's because of what we call skew. And it's a very, very natural thing in most instruments. You're not going to see it. You're going to see a little bit of an inverted skew sometimes in some stocks. NVIDIA sometimes does stuff like that ahead of earnings. Various kinds of stocks. You might see a little bit more of that in something like GLD gold, because people tend to pay up for the upside calls. So there's more of a, that's a safe haven. It tends to, people think of it as something that is going to be protective to the upside. So they're going to use upside to pick up calls. And so that kind of flow is going to push the upside to be more expensive. But in most cases, for most equities, if we're not getting into those kinds of things, or biotechs, or strange things like GME type situations, most of the time you're going to get that positive put skew. Now, this is a quick picture of what I'm talking about. You can see the at the money calls and puts are priced at around a 13 and a half vol. This is yesterday's, this is today's, 14 vol today. At the money implied volatility for 30 days. And we can see that as we go out of the money on the puts, we're paying quite a bit more. And as we go out of money on the calls, we're going to be paying or receiving quite a bit less. So this is your volatility smirk. And that's what plays into the pricing of the collar. Unfortunately, with the collar, you're actually giving up some volatility edge. You tend to be selling something for less and buying something that is more expensive. We're willing to accept that for the value that the collar can give us. But it's important to know that. And sometimes when the skew does move the other way, under certain conditions, we're going to get interesting levels of skew. We're going to be able to do things for less expensive. So for example, in the first half of 2024, we had downside skew very, very flat, meaning the out of the money puts were very inexpensive compared to where they normally trade versus the at the money and the out of money calls, right? So that was actually a structure that really made the collar quite favorable as a protective strategy. The fact that you were getting this structure, this downside put protection for less money than you normally would. You didn't have to be as aggressive on the call sale side in order to purchase those out of the money puts. So very, very nice. Now they've gotten more expensive again as we've seen volatility pick up in August and September. And so now we're having to pay up a little bit. But just so you know, that's how the skew works, and that's part of what's involved in how we price these things. We have to accept that part of the equation. So what that looks like on a P&L basis is the call price isn't as far away as the put price. You see that? The call price, the strike price, isn't as far away as the put strike price. And so this creates a little bit of a visual lopsidedness, right? We're willing to give up our stock sooner than where our puts begin to kick in. And that's kind of something that we either have to accept if we're going to try to do this collar for costless, meaning we want to try to receive more, as much for the call as we're paying for the put. So if we go on the call side and start to bring that strike in even closer to where the stock is trading, let's make that a 577, not quite. We're going to go 580. How about a 580? 662. We're getting pretty close to a costless collar here. If I receive, there we go, that's pretty close. So if I sell the 585 call, I'm going to receive $4.88, and I'm going to spend $5.28 on the put. So we're pretty close. We're about 50 cents away from each other at that point, 40 cents away. But again, what it does is it creates this lopsidedness where the put doesn't kick in quite as quickly. So that means your deductible is a little bit higher. But there is no rule that says you have to do this for even money, for costless. You can essentially structure this any way you want. And so what I would say is you could set your call up at 662 at the 595 strike. And now I'm going to only get 245 for that call, which isn't even going to cover half of the put price. But it may suit my temperament a little better. I don't want to give away my stock too soon. So I want to give the underlying a chance to appreciate to a greater extent. And that's fine. I'm going to have to pay for this particular structure. But that's okay. What we're really trying to do when you think of this is we're not necessarily trying to put on this structure for no cost. That may be a personal goal of yours, but that's not the important thing. The important thing is that this looks the way you want it to look, and that you are cutting down on the cost of the put on its own. So the put on its own right here would cost you $5.28. But that's fine. I don't want to pay that $5.28. I want to cut down on the cost by $2.45, so I'm going to sell that call. So think of the collar as something that you can play with in terms of the legs in order to get this particular upside downside profile to look a little bit more how you want it to look. I'm okay with spending a few dollars on this protection because I get that extra upside at this point. And if the stock market goes up 35 points, I'm going to be very, very pleased, and I'm not going to lament the fact that I paid a few extra dollars for this put protection. So that's how I go about thinking of these things. I don't necessarily think of, well, I just always want to do things for zero cost, right? I want to do it so that things look a little bit more the way I want them to look. So you can see in this case, I'm not getting as much for that call, but I am getting a nice little bit of extra distance there to that call strike. So I hope that helps you guys out. A little bit about volatility, a little bit about skew, and very much about the collar structure that can be very, very helpful in terms of creating a little bit of downside protection for when you are in, throughout the year potentially, but also through a difficult period of the year, perhaps through September, October, perhaps through an earnings season period, perhaps through an FOMC meeting, etc. Maybe an inflation number, a CPI number. You can put these collars on and take them off as you see fit. So we'll catch you guys next time. Hope you enjoyed that. Bye-bye.